The views and opinions expressed on this program are not necessarily those of this station, JVC Broadcasting Management, or its sponsors.
With so many people living longer, the fear of outliving your money becomes a reality for many of us. Will I be a financial burden? Will I outlive my money? How will I be remembered? My name is Neil Himmelstein, president of Main Street Planning Group. Please contact me by visiting mainstreetplanninggroup.com. That's mainstreetplanninggroup.com, or call 631-647-4694. I will introduce you to strategies that will guarantee you will not outlive your money, that can guarantee you will not be a burden on your loved ones. Through a collaborative approach, we will uncover solutions that offer tax-efficient strategies, lifetime income, and legacy planning, choice, organization, direction, and education. That is the code we stand behind. Contact mainstreetplanninggroup.com. That's mainstreetplanninggroup.com, or call 631-647-4694. And listen to me every Friday at 3 p.m. as I host the Main Street Code for Financial Success, right here on 103.9 LI News Radio. Good afternoon. Welcome to the Main Street Code for Financial Success. I'm your host, Neil Himmelstein. I'm here every Friday at 3. And when we talk about our code, we talk about choice, organization, direction, and education. And we help hundreds of advisors and individuals across the United States with their needs for life insurance, long-term care, disability, and annuities. You know, one thing about annuities, one of the great qualities that people don't understand is we can guarantee an income for the rest of your life. You know, it's not how many assets you have, it's your income. I mean, once you retire and you're not working and you don't have that paycheck every day, it's really nice to know that a check is coming in, not just Social Security, but you have your own check coming in, and you can create your own pension by buying an annuity that pays you an income for as long as you live. It just doesn't stop. And essentially, that's what Social Security is Social Security takes a lump sum of money and they buy an annuity for you. And they adjust that amount to your age and when you take it and how much money you've put in. So don't think that this is a bad word, annuities. Annuities can give you a guaranteed income for the rest of your life. That's a big deal. Well, what a time of year. We've got baseball teams in the playoffs. We've got the Liberty, the local basketball professional team in the playoffs, all vying for that gold. And we have, of course, the presidential election. And it's keeping me very busy studying and this and that. And, you know, Kamala Harris brought up a very interesting proposal the other night when I was listening. And she talked about having Medicare pay for home care for those who need long-term care services. And furthermore, she talked about the sandwich generation, those that are having to take care of their parents as well as their children. We call that the sandwich generation. And I'm glad she brought it up because it's a big issue. And the big issue is Medicare does not cover long-term care expenses. That means they don't cover a situation if you need help in your home and assistance with your daily activities of living. Medicare currently does not. When you apply for Medicare, it specifically says does not cover home care or long-term care services, period. It's in the application. So a lot of people think their health care is going to cover it, cover those kind of expenses, which 70% of us is going to need at some point. It's a very big issue. So the ultimate person who's going to cover that, or the way that's going to be covered, is typically by your family and friends, which could be very difficult. You might have to leave your job, or you might have to have your kids stay home from school to take care of you, or you might have to stay home from work to take care of your parent. All sorts of scenarios happen. That caregiver all of a sudden's got 2 jobs, maybe 3 jobs, which they didn't have before. So it's hard on that caregiver. As I've said in past programs, it's what killed my mother. Quite candidly, my mom took care of my dad for many years, and her taking care of her and pushing his wheelchair around and getting him out of the bed and getting him out of the tub cost her complete ability to function and pass away. It was a big contributing factor. Not the only, but of course a big contributing factor. So this whole thing is the biggest contributor to long-term care is really Medicaid is the number one provider of long-term care services outside the family. What is Medicaid? Medicaid is not Medicare. Medicaid is when you basically become impoverished, and a lot of attorneys will try and get you on Medicaid so that you can get government services. But basically, you have to impoverish yourself to get Medicaid, and then you might have some at-home care, or ultimately, they'll throw you in the place nobody wants to go, the nursing home. That's the role of Medicaid. Now, that is what costs Medicaid more money than anything, is this long-term care piece. So Medicaid is funded by the state and the federal government. They have an equal share in the state. So the other people that pay for it is then you can protect yourself by buying some sort of long-term care insurance. And that is the solution that's available today. So don't think anybody's just going to take care of you, or you're going to spend all your money until you can't. They're just not good plans. I mean, if you don't have a lot of money, maybe that's your best plan. But again, if you want to protect your assets, you buy some sort of long-term care. Now, long-term care insurance has evolved over the years. It's been around for about 30 plus years since I started in the business. It's very interesting. It's evolved. When they first came out with long-term care insurance, they underpriced it. They underpriced it dramatically. And the reason they underpriced it, and the reason they didn't understand it, is because at the time when long-term care became prevalent, insurance that is, they priced it so that they thought that the average stay in a nursing home at that time was 3 years. And the average at home, people at home, was about 1.5 years, 2 years. Those numbers never turned out, especially when medical science has gotten better and better. I mean, 30 years ago, you had a heart attack or you had a stroke. Next day, you were dead or just permanently impaired. And today, you can go in and out of the hospital in a day with a heart attack or something else. It's really dramatically changed. The diabetes, they've learned how to take care of that to some degree and extend our lives forever, pretty much, which caused the long-term care policies to be heavily utilized to the point of many long-term care companies went out of business or now are forced out of business because they could not pay all the claims. Because 70% of all people will need some sort of long-term care. Now, long-term care is prevalent because it's not only an emotional strain on your family members and yourself, of course, but it also affects your children, your spouse, and everybody else emotionally and financially, because it's very expensive to have somebody come in the house, or very expensive if your spouse has to quit their job to take care of you. So the biggest thing I tell people is you need to have this protected. Now, there's several ways of buying long-term care insurance now. You can buy it outright as a standalone plan. And please, don't wait till you're 70 or 80. You're not going to get it, okay? You have to start preparing in your 50s or your 60s. Most people wait too late. They go, oh my God, my house is on fire. Let me buy fire insurance. It doesn't work that way. You're going to have to go through underwriting. They're going to have to look and see that they know that they're not going to pay a claim like in the next 2 years. They're very careful about that, and they've gotten more stringent because of all the claims. So you have to be very cognizant of that and plan well ahead of time of you being sick or having an issue because you need to prepare. So long-term care insurance has the misnomer of being expensive. What's expensive is you need to go to an assisted living or a nursing home here in Long Island. Nursing home costs, $500 a day for a semi-private room. $500, $400, $450. The prices in New York are higher than elsewhere, but I got to tell you, how long can you afford $500 a day? That's $180,000 a year. Can you afford that? Can your family afford that? Can your spouse afford that? It's quite a bill. So we urge you to get some sort of protection and make a plan. So a lot of it will involve insurance. Maybe there'll be some legal work, but there are insurance options. After the break, I'm going to go over some of the different insurance options that you have at long-term care. You're listening to Neil Himmelstein. This is the Main Street Code for Financial Success. If you want to get a hold of me, I'm at 631-647-4694. If you miss an episode and you really are dying to hear it, or you're in your car, you can catch me on Apple or Spotify, or go to my website, themainstreetcode.com, and you can get the past episodes on my YouTube channel. And I thank you, and we'll be right back after break. Welcome back to the Main Street Code for Financial Success. I'm your host, Neil Himmelstein. Again, if you want to get a hold of me, I'm at 631-647-4694. And today's discussion is really, I'm talking about long-term care, but I'm talking about the sandwich generation. You know, we do a lot of family planning. We like to plan with the kids, with the parents, and with the grandparents. Long-term care is a big subject. It is humongous. Government is talking about it. Everybody's talking about it because it's the most expensive thing we're going to encounter in retirement, and we need to prepare for it. One way to prepare for long-term care is long-term care insurance. I'm going to get back to some of the different ways you can buy long-term care insurance. What if you can't get it? Okay, what if you're medically in a situation, well, I can't get it, well, I don't have a solution. We have solutions. One of them is to build up a side fund for yourself to take care of this. Another is, life insurance can be used as a long-term care, with riders. We'll talk about that. But also it could be used if someone passes away to fund somebody else's long-term care. Think about that. You have a husband and a wife, and the husband's, not in good shape, and the wife needs long-term care. Maybe they're two older people. Maybe you're an older person than I am, whatever, it's all good. And maybe you need to have a plan and you don't have one, and you're already retired, and, you can't physically, but you can get maybe life insurance that'll give you a fund of money if the other one needs it for long-term care. So it's not a bad idea if you can't get long-term care, but you're able to get life insurance to protect one another for that eventual need and expense. It's a unique way. It's not involving, either that or build up a side fund. And it's going to take a lot to build up a side fund, knowing that potential expenses could be, as I said before, maybe $180,000 a year, $150,000 a year. That's not chump change. That's real money. I don't care how much you're worth. That's real money coming out of your estate. And a lot of the people have a big problem because most of their money is tied up in qualified funds or IRAs or 401ks, and they've delayed taking that money, and that's their biggest asset. Well, here's the problem with taking that asset and why everybody delays it. Because they know they're going to have to pay taxes on that asset. So not only are you going to need care, but you're going to have to pay taxes and more taxes, even though you're not working and you need care. So that's a problem. So we do a lot of planning with creating a spending plan out of your IRAs and stuff and protect it on the other side. So you don't lose the money, but you protect it in a tax-free world. That's part of tax planning as well. So a lot of people talk about diversification of assets. They talk about diversification of stocks and bonds. You don't want to be all in one industry, and you want to have everything diversified. I like to talk about diversifying your tax classes. When are you going to pay taxes? Now, later, or never? Hopefully never. But Uncle Sam is your partner. Why are they your partner? Because they have to fund Medicaid to take care of your long-term care expenses. They have to fund, the roads, everything else. So we like to minimize our tax liability so that we can live in a nice world and pass on our assets in a nice, positive way. So that's why we diversify our tax classes. We can do that by having a well-designed life insurance plan with a well-designed long-term care plan, which is so important. Now, long-term care can be bought on a standalone policy now. It can also be bought in combination of a life insurance policy. Now, there's two ways of doing what we call a hybrid plan. One is if I have rainy day money, I know a lot of people that have rainy day money, which is smart. They have $100,000 sitting on the side. Well, this is my rainy day money. Okay, what's a rainy day to you? A rainy day to you might be, a tree fell on my house. A rainy day to you might be, I don't know, the kids have an emergency, or I have an emergency, medical emergency, or something. The biggest rainy day for most seniors is, I'm going to need long-term care. I'm going to need somebody to come in to take care of me, to maybe bathe me, maybe, drive me places, get my food, in general, take care of me, because at some point, the odds are I'm not going to be able to. So that's really what that rainy day fund. So with that lump sum of money, you could buy a long-term care plan. Okay, what a combination hybrid plan. It'll be a long-term care, but there'll be a little life insurance on. So if you never need it, it goes to your beneficiaries, your children, your spouse, or whoever. And also, you have access to that money later, but it'll buy a large long-term care benefit as a rainy day fund, maybe triple, what that fund is. So it's a way of putting your money to work for that rainy day fund to buy this lump sum hybrid plan. And you could pay it over 10 years or 1 year, but that's one way a lot of people, that's called an asset-based hybrid long-term care plan. Now you have a plan where you can put it as a rider as part of your life insurance. So what happens? In the better plans, let's say you bought $500,000 of life insurance because you need the life insurance anyhow. You want to take care of your spouse just in case, or your children and everything else, and you want to leave that behind. But the beauty is, if you need long-term care, it will take from that death benefit, that pool of money that you bought, $500,000 coverage, and it will pay that long-term care. And then whatever you don't need will go to your significant other. This is a way of not draining your personal assets or your retirement assets, as I said earlier, that it's all tax-free. You take the money out, it comes tax-free. You can take care of your long-term care needs. And that's how these hybrids work. Now, some of them work, to get into nitty-gritty long-term care, they either pay you indemnity or reimbursement. What does that mean? Well, with reimbursement, with a traditional long-term care policy or some of the riders, it may reimburse you for your expenses. A lot of times, though, they'll pay them directly. So typically, okay, I have a home care person, we spend $2,000 this month, and they reimburse you. But if you have a plan that says, okay, they're coming in Tuesday, Wednesday, blah, 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 they'll pay them directly, or they could reimburse you. Or you can have an indemnity plan. Indemnity means they pay you cash. So a lot of people like the life with the indemnity plan. And what it does is, okay, I'm on claim. I can typically get, let's say, anywhere from 2 to 4% of what my death benefit is. So if it's $500,000, I can get $10,000 a month. Pretty much forever, basically for 50 months. And they'll still keep the life insurance intact. But that's how the indemnity works. But you'll get that cash. Everybody loves the concept of getting cash. There is one little problem with it, though. If you're not capable of handling that money, then you're going to have to manage that. With the reimbursement plan, people think, oh, that's not as good. But, however, what you get is more of a managed way of managing your money because they have discounted services and other things. The other one gives you the check and says, have a good life. we're fulfilling our obligation, great. The other one actually has discounted services and other things with their reimbursement that they can help you navigate long-term care. Now, helping you navigate long-term care is a big deal. I remember when my father needed long-term care and he was alone, we had to hire an intermediary person to manage his drugs, to watch his things, and give us back a report. It was very important. So managing long-term care is very difficult for anybody in any family. We urge you to prepare. We urge you to call us at 631-647-4694. Please call us with any questions or any ideas or thoughts you have. Glad to help. And if you don't have a team, an attorney, insurance professional, an accountant that are all working together, let us help put together a team for you so that your plans work for you. That's the important thing. Have a great day. Have a wonderful weekend, everybody. Signing off. Thank you.
The views and opinions expressed on this program are not